Here are the crypto top headlines covered in this video. Big banks are nudging the SEC for a slice of sweet Bitcoin ETF action. Next, Avalanche blockchain plays key role in Citigroup's tokenization success story. Also, stablecoins could boost dollar as global reserve currency, says Fed governor. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We are a new channel here on YouTube and would greatly appreciate it if you would click on the like and subscribe buttons as well as the notification bell. It does help support the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline: big banks are nudging the SEC for a slice of sweet Bitcoin ETF action. The banking associations argued that U.S. banks were notably absent as asset custodians for Bitcoin ETFs, despite them playing that role for other ETPs. Major banks and financial institutions in the United States are pushing the United States Securities and Exchange Commission to readjust its definition of crypto assets, which could allow them to play a larger role in crypto, such as acting as custodians to the recently approved spot Bitcoin exchange-traded funds. On February 14th, a trade group coalition comprising the Bank Policy Institute, American Bankers Association, Financial Services Forum, and Securities Industry and Financial Markets Association pled their case in a letter to SEC Chair Gary Gensler. The group highlighted the recent approval of spot Bitcoin exchange-traded products in the U.S., noting that American banks were absent from the approved products as asset custodians. The Commission recently approved 11 spot Bitcoin ETPs, allowing investors access to this asset class through a regulated product. However, notably absent from those approved products are banking organizations serving as the asset custodian, a role they regularly play for most other ETPs. The letter requested that the SEC consider modifications to Staff Accounting Bulletin 121, or SAB 121, issued in March 2022, which provides guidance around accounting for crypto asset custody obligations. They stated that it has been 2 years since the issuance of the guidance, and there have been several relevant developments during the period, including the approval of spot Bitcoin ETFs. The current guidance requires banks to hold crypto assets on their balance sheet, which makes it costly and hinders their ability to provide crypto custody services at scale. The group has now requested the SEC narrow the definition of crypto assets in SAB 121 to exclude traditional assets recorded on the blockchain. This would prevent assets like tokenized deposits from falling under the strict crypto guidance. They also request exempting banks from the on-balance sheet requirements, but maintaining the disclosure requirements, allowing them to engage in certain crypto activities while still providing transparency to investors. In a post on X, Bitwise Chief Investment Officer Matt Hogan said the letter suggests that Bitcoin ETFs have changed the tone around crypto regulation in Washington, with others commenting it was a clear sign that banks are signaling interest in joining the digital finance wave. U.S. banks left off key Bitcoin ETF roles are pushing SEC to tweak guidance around holding digital assets, summed Bloomberg ETF analyst Eric Balchanas. Meanwhile, weekly Bitcoin newsletter author The Bitcoin Therapist added to the sentiment, bankers are getting pissed they can't hold spot Bitcoin ETFs for their customers. The Q1 FOMO is already driving them mad. According to preliminary data from Farside, total aggregate inflows to the newly launched spot Bitcoin ETFs have just surpassed $4 billion despite an acceleration in the outflows from Grayscale. Let me pause here for a moment If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline, Avalanche blockchain plays key role in Citigroup's tokenization success story. Citi believes that the vision for digital native products will unlock new capabilities and operational benefits, paving the way for fully auditable and traceable transactions. U.S. banking giant Citigroup has released a comprehensive report detailing the successful integration of distributed ledger technology, or DLT, into the private market sector through fund tokenization on the Avalanche blockchain network. According to the report, DLT offers a significant opportunity to revamp capital markets infrastructure, enabling innovative investment products and enhancing workflow efficiencies. It echoes the sentiment held by other big banks and some regulators regarding tokenization and its potential benefits. The report begins by tracing the historical evolution of financial markets from the early days of physical stock certificates to the electronic trading platforms of today. It emphasizes the gradual but inexorable shift towards digitization, a movement that has accelerated with the advent of blockchain and DLT. This historical perspective is crucial for understanding the significance of tokenization as not just another incremental change, but a potential paradigm shift in how assets are issued, traded, and managed. Proof of concept. Citi believes that the vision for digital native products will unlock new capabilities and operational benefits, paving the way for fully auditable and traceable transactions. The report is the successful culmination of the bank's tokenization proof of concept, or POC. The POC highlighted several key advantages of tokenization, such as streamlined workflows, the automation of compliance processes through smart contracts, and faster settlement times. These practical benefits testify to the feasibility and utility of adopting DLT in fund management and operations. The report also outlines the core benefits of DLT, which further include enhanced liquidity and the potential for fractional ownership of assets. These features are particularly relevant in the context of private markets, which have traditionally been characterized by high entry barriers and limited liquidity. Challenges in adoption. While the benefits of fund tokenization are compelling, the report adopts a balanced view by also addressing the challenges involved in transitioning to a digital asset ecosystem. Among these challenges are the need for robust legal and regulatory frameworks, the interoperability of different DLT platforms, and the integration of digital assets with existing financial infrastructures. Moreover, the report emphasizes the importance of addressing data, privacy, and security concerns, ensuring that tokenization does not compromise the integrity of financial transactions. Looking forward, the report calls for collaborative efforts among financial institutions, regulators, and technology providers to foster an ecosystem that can support the widespread adoption of tokenization. It envisions a future where digital and traditional assets coexist seamlessly, offering investors greater flexibility, efficiency, and access to a broader range of investment opportunities. Our next top headline, Stablecoins could boost dollar as global reserve currency, says Fed Governor. The rapid growth of crypto could threaten dollar dominance, but that's unlikely due to the popularity of U.S. dollar stablecoins, says the Fed's Christopher Waller. The popularity of United States dollar-denominated stablecoins in decentralized finance, or DeFi, may be helping secure the dollar's dominance as a global reserve currency, says Federal Reserve Governor Christopher Waller. About 99% of stablecoin market capitalization is linked to the U.S. dollar, Waller said at a central banking-focused conference on February 15th. People often conjecture that cryptocurrencies like Bitcoin may replace the US dollar as the world's reserve currency while are added. He noted, however, that most DeFi trades use stablecoins largely linked to the dollar. Crypto assets are de facto traded in US dollars, so it is likely that any expansion of trading in the DeFi world will simply strengthen the dominant role of the dollar. Together, the two largest stablecoins by market capitalization, Tether, or USDT, and USD Coin, or USDC, account for 90% of the $139.5 billion stablecoin market cap per CoinGecko. The two stablecoins play a vital role in DeFi, giving traders a liquid, largely price-stable asset to in on-chain activity without exposure to more volatile cryptocurrencies. Waller did note that the rapid growth of crypto could reduce reliance on the US dollar and cited it as a potential challenge to the currency's international status, but he also stated that there had not been any notable erosion in the dollar's dominance. I do not expect to see the US dollar lose its status as the world's reserve currency anytime soon, he said. Recent developments that some have warned could threaten that status have, if anything, strengthened it, at least so far. Lawmakers are close to passing a stablecoin bill after over 20 months of trying to reach a deal with House Financial Services Committee Chair Patrick McHenry, with Representative Maxine Waters telling Politico on February 7th that we're working on stablecoin, we're getting very close. Fed Chair Jerome Powell told Congress last June that the central bank sees stablecoins as a form of money and wants a robust federal role in overseeing them going forward. Months later, in September 2023, Boston and New York's Federal Reserve banks claimed stablecoins could inject instability into the U.S. financial system. So this concludes our top headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons, as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.